Hi, welcome to our April Tactical Workshop. This month we're going to be unpacking the federal budget with Cherelle Murphy, Senior Economist from ANZ. If you have any questions throughout the presentation, please enter them in the dialogue box and Cherelle will answer them at the end of the presentation. Over to you, Cherelle.
Thank you, Belinda, and hello everyone. Thank you for your time today. We are 2 days, of course, since the federal budget. We have a budget and reply speech today. Lots going on, lots to take in, and hopefully we can distill some of that information for you. So, what are we thinking about the budget? Well, obviously this was a budget designed to win votes, first and foremost. And of course, a lot of the benefits in this budget have gone straight to the household sector, which we would argue is quite appropriate. So today I'll just talk you through a few points from the budget and then I guess try and sum it all up to see what we think about fiscal policy and, as it currently stands. So of course the economy will get a boost, not only from those cash payments to households, tax cuts, particularly for low income earners, but also the business instant asset write-off and of course a little bit of money for infrastructure as well. We estimate actually that the cash benefits will add around 0.8% to household income. So that's not nothing. That's actually reasonably significant and probably quite well timed as well. The government has also left itself some room in the budget to spend a little bit more during the election campaign. That campaign, of course, we expect to be called within days, perhaps even tomorrow, and likely for a May 11 or 18 poll. The budget forecast to us look pretty reasonable. I'll come to a bit more detail on that. We're fairly comfortable about how Treasury is thinking about the economy, and we do think that it will be able to get to the forecast that it is presenting. But you know, there are some disappointments in this budget, and I'll come to those at the end, but they centre around the fact that we have now finished the process of fiscal repair. This is really the opportune time for the government or the opposition, whoever is in government, by the end of May to do some big thinking on economic policy reform, and that's what we would like to see going forward. Of course, that's all very easy for me as an economist, sitting watching from the outside, but the politics of fiscal policy are very difficult, and of course we understand that, and certainly not dismissing that as a challenge that the government sees going forward. So let's start at the beginning. This is, of course, the biggest news in the budget, the personal income tax cuts. Now, we have just cut these up into the various sections which have come through in the last few budgets. So if we start with the blue bars, that was last year's tax cuts, which came through, whoops, touch the screen there, last year's tax cuts which came through. The yellow bars were what the government tucked away in the mid-year fiscal economic update. You'll remember that that came out in December and the government gave some indications that it would be giving tax cuts, but they didn't tell us what they were. And then finally, we've had a little bit more added, which is the orange bars in this year's budget. So what we've graphed here is the cost to revenue for the government. So big tax cut coming through in 2019-20, again, mainly for low and middle income earners. That stays roughly the same for the next 2 years. And then once you get into 1st of July 2022, that's when we start to see the more substantial tax cuts coming through. But you know, the size of these tax cuts is quite reasonable. You know, we're looking at a $7 billion cost to the budget in 1920. And we also got a little bit more, of course, don't forget, in this financial year with the tax cuts, and also, of course, the electricity payments which have been made specifically to low-income households, mainly those taking pensions or allowances. And of course, as of yesterday, we had the government extend that to recipients of New Start allowance as well. So, put it all together, what does it mean for household income and consumption? As I said before, we do expect this to show up. In other words, this is not so small in terms of the size of the tax cut that households won't notice it. In fact, if we look at the orange forecast here, that's what we think will happen to household income with the tax cuts, as opposed to, apologies, as opposed to the blue line, which is the situation before the budget. So adds about 0.8% to household income, as I said. Certainly at least a milkshake and a sandwich out of that one for most households. So the important thing about this is, and I'll just sort of take you back through this graph, is you can see at the moment the household disposable income, no surprise of course to this audience, has been pretty low for some time here. In fact, back since 2016, it really hasn't been growing much more than that 2 to 4% rate. So the fact that we sort of see this picking up is of course highly appropriate. This will actually start to impact household budgets, particularly low and middle income budgets, from around about July this year. So that hit comes quite quickly, which is another benefit coming through into this calendar year. So again, at the moment, when household income is low, we see that as a great thing for the economy, absolutely needed. We have a household sector which, of course, has been, weighed on by low wage growth. A lot of people, of course, suffering down falls in their house prices, which, of course, is relevant to those who are in the market. And at the same time, we've seen that come through now in consumer sentiment, which has fallen. You can see that in this chart here. This, in the orange line here, is our consumer sentiment index, which we measure with Roy Morgan. It's a weekly index, so it always gives us a really good up-to-date feeling of how consumers are feeling. We will get an update on that next Tuesday, and that will, of course, incorporate the budget and the budget reply speech, and we'll be very much expecting to see some bounce in that number there. We haven't got the numbers yet, obviously. You can see that there is actually a reasonable relationship there between consumer confidence and actual consumption. So how consumers are feeling clearly does matter for the consumer spending numbers. And again, just to remind you, consumer spending is a large part of the economy, around about 55%. So it is, of course, incredibly important that we get consumers out there, again, feeling confident if we're to see reasonable economic growth going forward. So this will be something to watch in the next few days. Consumer sentiment clearly could do with a little bit of a pickup at the moment. As I noted, again, no surprise to this audience, but the house price situation remains fairly dire at the moment. We've had house prices fall now right throughout the country. Of course, we saw large falls earlier in Perth and Darwin. That spread to Sydney and Melbourne. But now even regional areas, we're starting to see house price falls. We do expect that from peak to trough, Sydney and Melbourne house prices will be about a 15% change. And although we are some way through that, we don't think we're at the end of the house price decline story. A little bit of good news there, though. We have seen a little bit of an uptick in some of the more forward indicators of housing prices. In this case, this is auction clearance rates, which have started to pick up just that little bit. There's also indicators that we put together, including an internet search term index, which essentially measures people's activity online and asks them, through Google, I should say, actually gives us some indicator of how many people are out there looking, and that's picked up too. So that's great news for those obviously selling a house, which actually includes myself. So thank goodness for that. But we are. As I say, this has been a bit of a drain on households, and again, it's one of the reasons that we see that these tax cuts in the budget should help the household sector a little bit more. Expanding, of course, on where the government's giving some money away, we've got the instant asset tax write-off extended, which is essentially a tax refund to the small business and actually the medium-sized business now sector instead. As you can see there on the left-hand side of the screen, the government, and I'm sure you've seen this all over the papers, has extended that income tax asset write-off to all purchases up to $30,000, and it's now possible for businesses with revenue up to $50 million a year to claim that instant asset write-off. So that's quite a big spend on the government's part. As you can see, it will cost the government about $200 million in next financial year, and then up to $500 million the year after. So up a $400 million spend when you net off the positives here, and that of course goes straight back into small businesses' pockets. It will benefit the retail sector, and again it should hopefully get businesses out there spending a little bit more than they have. Again, this is stimulus for the economy, which we think is quite welcome, and particularly for those poor retailers who are obviously finding it really tough at the moment. So again, pretty well targeted policy in our view. It's also been apparently an incredibly popular policy. You remember when it was first introduced, it was introduced for a short period of time, and then it was extended, and now it's been extended and made eligible for more businesses. So again, a bit more stimulus coming through there. Despite all this, and despite the fact that we see more stimulus in the economy, the interest rate markets have not gotten excited about the budget at all. In fact, they increasingly think that interest rate cuts are coming from the Reserve Bank. This is the front end of the yield curve, and what it's sort of suggesting to us is that there's around about 40-odd basis points of rate cuts coming from the Reserve Bank. Now, that is not something we agree with, and we expect that line to sort of bounce back up. We think the market's gotten a little bit excited about the possibility of Reserve Bank rate cuts. And I guess to some extent we're a little bit surprised by the fact that the budget didn't give the market some confidence that the household sector was going to be looked after by fiscal policy as opposed to monetary policy. Why do we think that? Well, a couple of reasons. One is, of course, interest rates are at a record low, the cash rate at 1.5% as it is. If you cut the cash rate further, it does take some time to flow through the economy, and we don't necessarily think that that will result in the sort of stimulatory impact on the economy that the Reserve Bank would ideally like. What does, however, of course, is fairly quick tax cuts and cash bonuses. We think that's got a much faster and a more stimulatory impact on the household sector. So, as I say, we were a little bit surprised that the markets hadn't read some of that into there. The other reason, of course, that we don't see the Reserve Bank cutting is because we don't think that cutting rates is going to solve the household's problem. Rates are already at record lows, as I said. Most of the problems for the household sector actually extend from the fact that credit availability has fallen. Now that's, of course, as a result of tightening of credit policies by banks, reflecting regulatory changes and, of course, the impact of the Royal Commission. These things are not going to be turned around by lower rates. These things, of course, are dependent on the individual macroeconomic prudential policies and also how the banks react to the market. So that's something that we'll be watching. But as I say, we don't think that the RBA just cutting cash rates is a quick fix to the household sector's problems at the moment. And that's why our core case or our core forecast is for rates to remain unchanged. Now, obviously, there are those in the market that disagree with us, and I guess our caveat to that is if we did see a softening in the labour market, we would change our view there because that's something that the Reserve Bank is not going to tolerate at all. And if you saw a softening in the labour market, then we would expect to see the Reserve Bank come in and act. So, of course, we watch that with minute detail. Every statement that the Reserve Bank makes, we're there getting an eye on that, and you can keep up to date with our thinking on that through the weekly notes that we put out from the research team at ANZ. But as I say, back to the budget. As I said, the markets have not responded as if this is a stimulus. In fact, it's almost the story here is clearly the opposite. If we talk about, of course, the budget, we have to make an assessment as economists as to whether or not we think that the budget's forecasts are reasonable. Because, of course, it's only if the economy grows largely in line with what the Reserve Bank, the Treasury is thinking, that we'll actually get the results. Now, this, just to give you an idea, is the nominal GDP forecast that the budget produced, so the orange bars over the current and the next 3 financial years. We've compared this to the MYEFO, so this is the mid-year economic statement, of course, released in December, and we've put our own forecasts on there too. As you can see, what the budget has done is actually taken growth up for the current financial year, and that reflects the fact that we've already seen most of that come through. We've seen good rises in commodity prices, boosting our income as a country, and that's come through into strong growth of about 5%. We at ANZ, as you can see, think it might even be a little bit stronger than that. We won't get those results for a few months yet. For next year, we do expect growth to take a little bit of a step down. There's a few negatives obviously affecting the economy at the moment, including the turn in the residential investment cycle. We don't expect commodity prices to stay as high as they have been. We also will see, as we know, we had seen a little bit of a slowing in the household consumption, which takes those numbers down a little bit, and that's regardless of the tax cuts. So a little bit softer growth in next year. We are slightly ahead of the government, but we certainly wouldn't quibble on those forecasts. And the next financial years, as much as they're of interest, and really, you know, these are getting quite difficult to forecast, these 2 years, but the government does see a bit of a return to more, I guess, longer term growth rates. You know, we don't even really bother forecasting it that far because it is very difficult to get that right. But certainly in the short term, we think that the Treasury have produced quite reasonable forecasts. In fact, potentially even a little bit on the conservative side, as you can see, our forecast a little bit stronger than theirs. So that means that they should be able to quite easily produce the surplus which they are expecting in 2019-20. So that's a $7 billion surplus. That comes through here in the blue line. As you can see, compared to December when they released the mid-year economic fiscal update, they've upgraded that by a few billion dollars, about $3 billion. And for the next few years, it's, you know, much of a muchness really about where they've changed their forecasts. The important thing, of course, is that from these deficits here, we've seen this very steady improvement in the underlying cash balance, and we've got good reason to believe that that will continue. As I say, revenue's growing a little bit stronger, and also expenses have been a little bit below the government's expectations. So this profile, this getting back to surplus, seems quite reasonable. We're not there yet, though. Of course, it's not until 2019-20 that we would see that surplus coming through. Interestingly, in the budget, they also revised down the deficit for 2018-19, so our current financial year. You know, there's a big number in there which suggests that some of the local government grants that were to fall into this year have been moved into that year. Kind of convenient. Basically, it means that they can get a bigger surplus next year, and then everyone will be forgotten about this 18-19 year very soon. But no, I'm quibbling really, and the really important thing here is that the fact that the trajectory for underlying surpluses is there, and it is believable. Of course, the return to surplus has been a very significant part of the government's mantra, and to not get there, of course, would punish it politically. So, underlying cash flow balance looking better. The net debt numbers, which, as we know since the global financial crisis, have risen very quickly, still at a fairly low percentage of GDP, still sitting around that sort of 30 to 40% range. By international standards, that is quite low, but it's the speed of the increase that had caused a lot of concern. So what we have seen in the budget is that they revised the net debt numbers up just a little bit for the current financial year, and from there on in expect the net debt numbers to fall. The MYEFA, again, that December statement showed a very similar profile. What takes that number up is actually a change in the market value of Australian government securities, so Australian government bonds. So that's almost more of a reflection of market pricing than it is of the government spending more money. And I'll just go back, when you see surpluses like this, then of course net debt comes down because you're using the surplus cash to pay down your debt. So we're sort of fairly comfortable again that the government can produce those numbers. Notably, the rating agencies have come out and not given any particular statement about the credit rating, but they've certainly not changed it. So in other words, the AAA credit rating from Standard & Poor's stands at this point in time, and that's exactly what we would have expected. No stresses there. A broader measure of the, I guess, the debt burden of the government is net financial worth. Now, this has increased more sharply than net debt. This gap here is largely due to the way that fund investments are treated in the future funds assets, and so we've started to pay more attention to the orange line than the blue one. It has been rising faster, but as you can see, the trajectory for net financial worth is also for an improvement going forward, and again, we're fairly comfortable with that. So as a measure of broad financial sustainability, you do want to see these numbers come down. Apologies for that. And that certainly is the case at the moment. So that looks okay to us as well, and also notably to the rating agencies. One thing that we'd point out with the budget is it does rely on, as we've said here, the no bad news scenario. In other words, it's expecting the economy to continue along at a fairly good trajectory. It is expecting receipts as a share of GDP to continue to just creep up there. So the dotted lines are the MYEFO, the December numbers. The darker line is the budget numbers. As you can see, receipts expected to go up. Payments, which are the blue line, expected to come down as a share of GDP. That's not easy for governments to achieve. Essentially, it means that they have to spend less relative to the size of the economy. But of course, that is what is guiding the surplus projections. You can only get to a surplus, obviously, if your revenues are greater than your expenditure. I've also noted in there, this is the rule that the government's put on itself, that its tax revenue, so the part of its receipts here, the orange line that is made up of taxes, has to not exceed 23.9% of GDP. Why 23.9%? No particular reason. The government has just used that number as I guess, a benchmark as where it doesn't want to go over. The argument being that it starts to swallow too much out of the economy through taxes. So in all of its forecasts, it's very careful to keep that yellow line there below the solid yellow line. So that's a rule, as I say, the government has set itself. But the point I just want to make here really is that if we have an economic shock which causes our receipts to fall, for example, a big fall in commodity prices, or something, obviously the GFC was a big impact here. You can see how quickly receipts fall away when we get a crisis of that size, then this scenario of getting to surpluses just completely fades away. So it's based on the fact that things are business as usual and the economy continues to grow fairly solidly. Again, not outside our expectations, but it's just worth pointing out that this is a risk. We've heard a lot from the government about its infrastructure spend. I've seen many, many numbers used in the media about how big this infrastructure spend is. Now, what we do is we add it all up and we compare it to the last numbers that the government published, again, in the mid-year statement in December. And when you do that, you see that the additional infrastructure spend as a result of policy announcements in this budget was only $9 billion. That's not a particularly significant amount of money when you're talking about annual spends of close to $45 billion. Now, it's very contentious how you measure this, but we do it in a way which splits the government's capital spend, if you like, into three parts. One is its direct capital investment, which is the yellow bars. So that's actually mainly defence related. So it's defence related equipment. Not a particularly large spend, and as you can see, expected to fall away just a little bit. And then there's the capital grants to the states and territories. Now, these were particularly large after the global financial crisis, when the government, of course, was using its fiscal policy very actively to maintain growth in the economy. And so here what we had was the schools building program, you remember, for all its controversy, but what it did do was it added a lot of capital spending to the economy. As you can see, since then, those red bars have gotten smaller and they are expected to remain fairly small. The government is not so keen to just hand money over to the states and let them spend it the way it wants. What it started doing instead is these financial asset investments. So it's equity injections into corporations which are supposed to make money, and that's why it can all happen off balance sheet. So these light orange, or these orange lines here, don't show up in the budget. But we think it's important to put them together with the other direct forms of spending so we can get a better idea of the total capital spend of the federal government. As I say, when you add these all up, you can see it's actually fairly flat. And compared to MyEFO being the December update, we've had a little bit of an increase as a share of GDP. But as you can see, it's only really quite small. And as I say, it adds up to about $9 billion. So certainly not the $100 billion number that we've been reading about in the press. And I always suggest that you're very careful when you read the glossy brochures out of the government, because there's a number of ways to cut the data, and of course the government will always choose the one that advantages them and sounds the best and wins them the most votes, but we like to look at it a little bit more soberly. Nevertheless, you know, the fact that we have had some small increase in capital spending expectations is of course a good thing, and we're not suggesting it's not, but it's just not a particularly spectacular number. This brings me to the outlook for public sector spending more generally, and of course remembering that most of the money that goes into public sector infrastructure is actually coming from state governments, not the Commonwealth. So what we also like to do as a bit of to broaden out our analysis of this area is to look at the major public-backed infrastructure projects. So these are the ones worth about $2 billion or more. As you can see, and please, I don't expect you to read this, but you can have a look later, is essentially that the profile here is of very, very strong spending up through to the current financial year, and from here on in, it will be a bit weaker. And for the sake of forecasting economic growth, this means a bit of a flatter, in fact, a falling profile for public investment, which up until recently has been a really good source of strength for the economy. Now, of course, if you live in Sydney, you can see this firsthand with all the construction going on there. Even in Canberra, where I live, the light rail's numbers in there somewhere, and of course a lot of infrastructure spending going on in Victoria as well, which is lifting these numbers. But from here on in, these numbers will be lower. There's certainly historically high levels here, and so coming down here is more normal. But for the growth numbers and for the economy, we have to keep an eye on that decline and how quickly that decline comes, because of course when projects finish, jobs get lost and there's a lot less money flowing through, and it's something that can slow down the economy quite quickly. These are very labour intensive projects, so something worth keeping an eye on, and one of the reasons that growth will be a little bit softer going forward than it had been before. So to just take a step back from the announcements in the budget, what we've asked ourselves is, was this a sensible budget for this point in time? We know that we've had a very tough run since the global financial crisis in terms of government finances. The global financial crisis, as I was saying before, really did zap revenues. And so it's taken a long time for the government to get to a point of recouping that, if you like. We've, of course, been helped by the fact that our commodity prices have been very strong, which means that mining companies, of course, have been paying large company taxes, and a lot of the benefits of that have flowed right through the economy. But we're now at the end of that process. We've now got a surplus, and a very realistic surplus projection going forward. The question is what the government is doing with that surplus the best thing they could be doing? And when I say the best, I mean for the long-term potential of the economy. In our view, Probably not. Certainly some of the short-term policies that have been put in place are sensible. Here I'm talking about the tax cuts, I'm talking about the electricity bonus or whatever you want to call it. Essentially it's a cash bonus to low-income households. These are all welcome at the moment, as I was saying, because the household sector needs a boost. But if we're talking about 10 years, 20 years down the track, what is the best thing that the government could do with its surpluses, then, you know, really it takes a bit more creative thinking about the long-term potential of the economy. We've just highlighted here, and again, I'll leave you to sort of digest these later, but we've highlighted some areas where we see the government could really have been putting a bit more effort into, I guess, lifting, again, that productive potential of the economy down the track. Getting workforce participation rates up, very stimulatory for the economy and very good for the long-term growth of the economy. That's both getting women's participation rate up and also older workers. Getting innovation going. Now, that's not all about just an R&D tax offset. It's much more complex than that, but certainly anything the government can do in that space, very welcome. You know, the intergenerational equity is a big part of the story. We did see some more superannuation tax breaks for people in the 66 and 65 year group, and that cost the government a little bit of money. Is that sensible? Well, you know, no one wants to argue with giving people their hard-earned taxes back. But, you know, there's certainly issues of how much money you want to give the older generations who have benefited a lot from superannuation tax breaks versus the younger generation who are essentially paying for the pensions, and when they become retired, of course, there's not going to be as many people to pay for theirs. So the intergenerational issues are very difficult for governments to manage, but something we think that needs a close attention from the government. Of course, climate change, something that many in the media and many interest groups, you know, from the left and from the right, have suggested that could have received a little bit more attention in the budget. I just want to finish on a point, and it's a very interesting statistic here. 48% of our voters are now over the age of 50. Now that is a number that surprised us, and we can just see that here. So we have, this is of course the baby boomer generation, and it's clearly a very important part of the voter base which the government needs to appeal to ahead of the election. This is, I think, why we are seeing some policies which are very much focused on the older age groups as opposed to the younger ones, and it's clearly skewing the government's policy thoughts going forward. But it's just something to keep in mind when we're looking at the budget and thinking about the election and where the policy focus is, because clearly it's something that, as I say, there's a lot of numbers behind that baby boomer generation. I will finish off here, and I believe that Belinda is going to bring some questions from those who are dialed in, so thank you.
Thanks so much, Cherelle. It's definitely a very insightful look into the budget. It's such a difficult thing to digest as a layman looking at it, so that was really helpful. So given that you think the budget is optimistic, do you think it's realistic?
Yes, I do. I mean, I think that it's optimistic in the sense that it returns to surplus, and I'm sure that's the basis of the question. But yes, I do think it's realistic because the growth numbers and the commodity price forecasts on which it is based are actually quite sensible. So yes, we do. Yep.
I'm not sure if you'll be able to answer this one or not, because I know you're not an expert on the housing market, but
yep.
Have you got any comments on the proposed changes for the negative gearing?
Yes, from the Labor Party. Yeah. Look, yes, we do. So the policy is clearly about trying to rein in some of the expenditure related to housing through the tax system over the long term. But you know, obviously two big changes here are the introducing or eliminating the negative gearing from for existing housing for investors, and also halving the capital gains tax benefit. And we now know that those policies start from the 1st of January 2020. Two things there. One is, if you've got that policy starting in 2020, we actually think there might be a little bit of activity in 2019 as people try and get ahead of those, because of course the policies are being grandfathered, which means that if you are thinking about buying an investment property and you are close to the point at which you can, there are certainly tax benefits of getting ahead of the start date of the policy, if of course we saw a change of government at the election. So in some ways, we actually see this filling up the economy a little bit in 2019, which is interesting, if there was a change of government. Down the track, there's been a lot of commentary about the fact that this might reduce house prices and have a very detrimental impact on the market. Certainly we do see a small negative impact on the market, but we do see it as small, and part of the reason for that is because tax is only one reason that people buy an investment property, and clearly the aim is not to make a loss through the entire life of the policy. So the way that we think about this is, what is the sort of change in price or the change in rents that would be required for the investor to be no better or worse off as a change of the policy. And when you feed that through the numbers and you calculate the net present value of that amount of money, it's actually not huge. And that's why we don't think there'll be a major depressive impact from the change in policy, if indeed it happens.
Who knows?
Who knows, yeah.
So does the budget surplus include debt reduction, or does it just include interest repayments?
Does the surplus?
Yeah.
It includes both, yes. So you get both a debt repayments are just par for the course, so that's always in there, that's always part of the budget expenditure. And even despite the fact that we've got debt at a fairly high level historically, on the basis of the current numbers, we should actually see debt slowly reducing, simply because we have surpluses, right? So we have surpluses, we have money to pay off debt. And the capital expenditure, which sits outside of budget, is not so large that it eliminates that. Now, the big question with this budget is there's a federal election in sort of proposed 6 weeks. Yes. How do we think things will sit if there is a change of government? The current budget won't be able to be delivered to its full extent. Do we expect that if there is a change of government, we'll still be able to see a surplus in the next couple of years? Yep. Good question, because essentially this budget is an election pitch, actually. It's not really a budget in the most normal sense that we usually see it. So whether or not we get a surplus from here on in, of course, depends on who's in government and what if there was a change of government, what the policies of the Labor Party would be. Now, I would think, and I don't know, and we'll get more information on this today, that the Labor Party will not plan to spend much more than the government has. In fact, the opposition leader has said that basically every spending policy that they have has to be offset by a saving. So if that is accomplished, and that's not an easy thing to accomplish, but if the alternative government were to do that, then we should absolutely maintain a budget profile which is the same as that's currently in place. Now, to add to that, though, the government, or the opposition I should say, have suggested that they will spend more money on low and middle income taxpayers, so a bit more of a bonus there for the very low income earners, including those on pensions and allowances. Now that may come at a cost, and that may make the surplus a bit smaller next financial year, but I wouldn't think it would eliminate it. In fact, I think the Labor Party will be very conscious of maintaining a surplus projection, because it is a big political conversation. Absolutely, it's their election bid, isn't it? Yes. Yes. So, bringing out your crystal ball, what do you think the opposition tonight, when they release, I guess, their sort of response, what do you think their big ticket items will be? Where will they be looking that maybe the current government hasn't looked at? So what will be their points of difference? Yeah, well, clearly the very low income earners, I think that's going to be their biggest point of difference. So they're talking about giving more back, whether it be would be cash payments to those who earn less than $40,000 a year. So again, that's mainly people on part-time or very low paid work, and also those on allowances and pensions. That's definitely going to be the centrepiece of their pitch. There is some talk around how to differentiate help for the regions as well, I've noticed in their commentary. So sort of providing more services to the regions as opposed to just building more roads. That seems to be a point of difference. But of course, the big ones for the long term are the policies on negative gearing, and capital gains tax, and also removing the credits for dividend imputation, which again is something designed to save the budget long term, and in the short term could be quite unpopular with some people. In fact, as we know, is unpopular with some voters.
Oh, fantastic. It'll be very interesting to see what happens from the opposition.
Indeed, yes.
Thank you so much, Cherelle. That's been really informative. If you want to keep up to date with developments in the economic outlook, especially in this very tumultuous market with an election on the cards, make sure you follow Cherelle on Twitter and ANZ. You can look up the Twitter handles at ANZ_research or at Cherelle Murph Fry, and you'll be able to stay up to date with any changes in the market. Thanks once again, Cherelle. I hope you've enjoyed this presentation.